Okay, good morning. I'd like to get started, please. I assume you've all seen the outcome of the election, and we discussed the Iowa Electronic Exchange over the last week or so, and it appears as though the exchange once again has done a better job than some of the polls in predicting the outcome, because as you know, the probability that Arnold would win was at 90% all last week. So it was interesting to see how accurate that market was. I'll remind you that we have a quiz on Friday, the second part of the class. It'll be on chapters 1 and 2. Also, the deadline for trading in StockTrack is Friday, so by now you should have signed up, have your account, and we'll be checking to see if you've traded, and by trading it just means opening a position. That's all you have to do before Friday to earn 5%. If you fail to do that, that part of the grade you get a 0 on. Okay? If you have any problems with StockTrack, some of you I know have signed on and it seems like you're having trouble actually making a trade, they have a toll-free number to call. Because if you have your account number and your password and you signed on, you're probably doing something wrong, and there's nothing that I or Montisha can do to help you with that. You'll have to contact StockTrack. Okay? So I'd just like to finish one slide on chapter 1, and then we'll move on to chapter 2. And many of these points we've already discussed in class, and this has to do with the economic function of futures and options markets. I've mentioned that the U.S. government believes that these markets serve a useful economic function as long as they are properly regulated. And basically that means that the government regulatory agency keeps an outlook over the markets to ensure that they're competitive and there are no attempts at market squeezes, as we discussed on Monday. So some of the economic functions include the following: providing a return for storage. When we discussed the history of the formation of the Chicago Board of Trade, I emphasized the fact that prior to the introduction of these contracts, there was always a surplus of grain on the market immediately after harvest and a shortage immediately before the harvest. So what the markets have done by providing a set of intertemporal prices, and that means you have prices for different points in time, by providing a set of forward prices, it also provides a return for storage, because you could buy the physical commodity today, sell a distant futures contract, hold that commodity in storage, and deliver on the futures contract. And typically, the distant months are priced above the nearby months for deliverable commodities. So that sort of activity, we call that an arbitrage activity, where you buy in one market, so you're buying in the spot, you sell in the futures market, you hold the inventory and deliver on it. You could lock in a certain return, assuming that the price you're buying at is less than the futures price. And therefore, the markets have provided a mechanism to pay warehouse owners a return for storage. As a result, in the storable markets, the introduction of futures markets encouraged more storage. Grain was taken off of the market immediately after harvest, and then it was slowly sent to the market during the crop year, and there was some available at the end of the crop year prior to the next harvest. The next 2 points, disseminate information and discover prices, are very similar, and we've discussed these already in class. And I'll refer you to the articles I've sent you recently over the email class list, and I remind you again that these articles are required reading. So you may see some questions on the quiz with regard to these articles. So I sent you an article from the Wall Street Journal over the weekend, and the title was Dollar Regains Strength, and it was an article about the U.S. dollar gaining strength against some foreign currencies, in particular the European euro, the Japanese yen, largely because of a positive employment report that came out, which sent the stock market up. It sent the bond market down because interest rates rose. gold prices fell, and the dollar appreciated against some of these major currencies. So that news was over the weekend. And then on Tuesday, I sent you an article yesterday, and the headline was, "Dollar falls against most rivals, an absence of fresh data." So on Friday, the dollar was rising. Tuesday, the news was the dollar's falling. And this is not unusual in these markets. Okay, one day the news is bullish, the dollar's up. The next day the news is bearish, the dollar's down. Why is that? Because of information that flows into the market. Last week, the employment report was a surprise to the market. That's why the stock market, the gold market, and the bond market, and the currency market reacted the way they did. And it's kind of interesting because you can see how these markets are tied together. Because the release of that one report affected all four of those markets. However, some traders were saying they'd like to see more information, and that one single report was insufficient to convince them that there was strength in the U.S. economy. So perhaps that explains why the dollar started to slip against the major currencies again this week. And I checked it this morning, and the euro is up again this morning, so the dollar is continuing to slide. So that underscores the point that the market disseminates information. When the information with regard to the employment statistics were released, immediately the prices reacted. And this is a characteristic of an efficient market. In the book, I have a little story about our President Bush, who was visiting Japan a while back, and he had a meeting with the Japanese Prime Minister. And after the meeting, at a press conference, President Bush talked about his discussion with Japan's Prime Minister, and he said that they discussed the problem of depreciation, and immediately the market reacted because they thought Bush was talking about a depreciation of the Japanese currency. But actually he meant to say deflation, which is a different concept totally. Deflation has to do with falling prices, not with a falling currency. So in the meantime, some traders lost a lot of money, some traders made some money because the currency markets reacted to that single statement. So that's typical of these markets. They're looking for news. News flows in, the price adjusts. This is a way that they discover prices, because you can think of the market as being the central clearinghouse where all the information comes in from around the globe. It's funneled through the telephones onto the trading floor, and through buying and selling, we're evaluating the price of the US dollar today, the price of gold today, and the price of T-bonds today, etc. That's why the market moves very quickly, because information comes in at a rapid pace, and we can't predict what information we'll see tomorrow. Another factor that's driving the dollar down this week is instability in the Middle East. Israel's talk of bombing Syria has again sent the dollar down. So who knows what will happen there? And if some news comes in from the Middle East, you could see a sharp movement in the currency this week as well. But that's useful because the market does a very good job, as I told you last week. It does a better job than anything else out there, anything else being attempts to forecast prices. The market pretty much beats all publicly available attempts to forecast prices, and therefore it serves a very useful economic function. And finally, we have the notion that the market shifts price risk. I've talked a little bit about hedgers. We'll get into that later in the class. And basically this addresses the role that the market has by allowing hedgers to reduce price risk. And we've talked about hedgers, we've talked about the airlines, we've talked about banks being hedgers, we've talked about farmers being hedgers. They're all exposed to underlying price risk, and they can reduce some of that risk by taking a position in the futures or the options market. So those are the key reasons why the futures and options market is viewed as being a very important economic institution, and it helps explain why we've seen this rapid growth in volume of trade, both in the US, also in Europe, and in Asia. So, Chapter 2 pretty much focuses on explaining some of the terminology in the markets, explaining some of the market mechanics. One of the more important sections in Chapter 2 is the discussion of the clearinghouse, and I'll go through that today, and hopefully that will help bring everything together. I know that you're still trying to get your hands around this complicated institution, how you can sell something you don't own, what exactly are you buying or selling when you're buying or selling a futures contract. I think that will help when we go through the example of the clearinghouse. But these are some of the terms that you'll run into in Chapter 2, and I've used them in class to some extent. The broker refers to an individual or a firm that trades on behalf of the public. In other words, if you or I want to trade in the futures or options markets, in all likelihood we go through a broker. A membership on the exchange costs several $100,000. The brokerage houses have memberships, and they will execute our trades. The clearinghouse, and I'll go through that example in a few minutes, is really a subset of the exchange. There's been recently there's been a dramatic shift in the legal structure of futures exchanges. Until a few years ago, the large exchanges in the US were all nonprofit enterprises. In other words, they had a membership of, let's say, 500 members who would pay $400,000 or $500,000 per membership, and there was a finite number of memberships. So if you wanted to buy a membership, you'd have to purchase it from an existing member, sort of like joining a golf club. So there was a finite number. The price fluctuated from month to month. If someone wanted to sell a membership, they put it up for sale, and it went to the highest bidder. That membership gave you a right to be on the floor and to trade on the floor, or your representative could be on the floor. The Chicago Mercantile Exchange was the first to move away from that slightly, and they actually have shares now. So it's now a for-profit company where the memberships were turned into shares. And many of the other exchanges are moving in this direction. But that's a subtle change that doesn't really, we don't have to think about that too much. The memberships, as I say, might total 500. Of that membership, perhaps 250 form the clearinghouse. It takes a lot of money to buy a membership, but to be a member of the clearinghouse, your liquidity must even be higher because it's the clearinghouse that guarantees the integrity of the trading. I've mentioned before that at the end of every day, the exchange, which is really the clearinghouse, marks every contract to market. They bring every open position up or down to the closing price. That's really done by the clearinghouse. So it's the clearinghouse that matches the trades at the end of the day. There's a lot going on the trading floor. Every trade that's conducted on the trading floor, through all the shouting and the waving and so on, must be settled at the end of the day, so it's cleared through the clearinghouse. Basically, the clearinghouse balances the books. As we've said, for every long there must be a short, and the clearinghouse keeps track of the longs and the shorts. And we'll see an example of that in a second. We've already talked about hedgers and speculators. We've already talked about being long and short. These are terms that you should be familiar with. Long means to buy, short means to sell. I've talked about bids and offers. If you're trying to buy on the floor, well, you're bidding. If you're trying to sell, then you're making an offer. Liquidation, that refers to reducing a previously established position. Okay, the other day in class, I bought one T-bond contract. If I sell it this afternoon, I'm liquidating my position. We saw in one of the markets, I believe it was corn, that open interest had fallen over the last week in the nearby contract. That suggests that there's liquidation going on in that market. Individuals that have outstanding contracts are reversing them. They're liquidating. Carrying charge, that refers to a set of intertemporal prices. If we look at, let's say, December corn, January corn, March corn, June corn, if we look at the set of prices, the more distant month is normally priced above the nearby month. So June would be above March, March would be above January, and January would be above December, and December would be above the current cash price. That's what we call a carrying charge market, where the further you go into the future, the higher the price. And again, that refers to the fact that the market is reflecting a return for storage. And if you carry product forward, you buy it today and you sell it in 2 months' time, well, in order to earn a return for storage, that price for delivery in 2 months must be above today's price. Otherwise, the return is negative. I've talked about volume and open interest when we looked at the Wall Street Journal yesterday, or Monday, I should say. We looked at the Wall Street Journal. Volume is simply the number of trades in a given day. So it's just the number of contracts that are traded. And for every contract, you have one buyer and one seller. We also discussed open interest. Open interest is a cumulative concept. Unlike volume, where volume is just how much volume was there today, how much volume was there this week. Open interest measures the number of outstanding positions, the number of outstanding contracts that have not yet been liquidated. In corn, we saw the nearby had 200,000, more than 200,000 open interest. So that means there are more than 200,000 open positions. And of course, for every open position, there has to be a long and a short. Because to execute a position, there has to be one long and one short. And so open interest is either the sum of the outstanding longs or the sum of the outstanding shorts, because they're equal. It's not the sum of both. It's simply the number of contracts that are open. Puts and calls, I briefly mentioned. We'll talk about that later. Basically, a put is the right to sell a futures contract. That's a term we use with options, and a call is a right to buy a futures contract. So this little graph helps explain sort of the legal structure, if you like, of the exchange. So in the center here, you find it? In the center we have, the futures exchange, and we've talked about many different exchanges. I've shown you a list of what's available in the U.S. And of course, we have our buyers and our sellers who place orders into the exchange. And the buyers are comprised of hedgers, speculators, commercial firms. As with the sellers, you can have hedgers that are selling, you can have hedgers that are buying. It depends on their exposure to the price on the cash commodity. And obviously you can have speculators who are buying and selling. So we see speculators in both categories, we see hedgers in both categories and other firms. So those buyers and sellers place their orders onto the floor of the exchange, either directly. The large hedgers will actually have a membership and they will do their own trading, or indirectly through a brokerage firm. And all the large brokerage firms also have memberships. So those orders go up to the exchange. As I said, the exchange is regulated, and there's some government regulation that was recently redrafted that oversees the operation of the exchange. As I mentioned, there's a bit of conflict between the New York stock market and the Chicago futures markets. People associate futures with Chicago because there are two different agencies that regulate these markets. The SEC regulates the stock market, and the CFTC, the Commodity Futures Trading Commission, regulates the futures market. The SEC would love to take control of futures markets, and they argue that these markets are now so heavily weighted towards financial futures, and they're trading stock indexes and so on, that that should really be under the purview of the SEC. But to date, they have not convinced the government of that, and the rules were rewritten to really strengthen the hand of the Commodity Futures Trading Commission. So that regulatory agency, the CFTC, registers all brokers, registers all traders that are trading on behalf of the public. So if you're trading from Davis, you go through a brokerage firm in Sacramento, that firm will be registered with the CFTC. So the CFTC evaluates their financial position and authorizes them, essentially gives them a license to trade futures and options on behalf of the public. Like other financial markets, this is also an industry that attracts some unsavory characters, I should say. So on the CFTC website, you can also find mugshots of individuals that have been convicted of trading fraud. And it's not unusual for you, if you're up late on the weekend, to see these infomercials on television or on the radio. You know, we'll soon start hearing about heating oil. And you'll hear an ad basically that tells you we're going into the winter months, now's the time to buy heating oil futures, and heating oil futures always rise in the winter months, and you know, you could make 400% return, this type of thing. Some of these characters are not really approved by the CFTC, so there is that fringe group that the CFTC keeps an eye on. In addition to that, the CFTC establishes position limits for large speculators. Somebody asked me the question about cornering the market or a market squeeze. Well, the CFTC establishes the number of contracts that any one individual or firm may hold as a speculator. They also audit the open positions on a regular basis, because if a brokerage firm is trading on behalf of a speculator and they violate the rules, then the brokerage firm will lose its license as well. So those are the sorts of things the CFTC does. It also approves new futures markets and new contracts. I sent you the article about the Eurex coming to town. The European Electronic Exchange is about to start up in Chicago's back door. They will have to be approved by the CFTC before that exchange can open. So the exchange, as I mentioned, has a group of members or shareholders. They elect a board of governors that oversees the day-to-day operations of the exchange. The exchange collects a small fee through every trade. It'd be $1 or $2 per trade. We mentioned the electronic exchanges can do it for less. That fee pays for the building and keeps the lights on and the heat. And the board of governors tries to ensure that all the rules are enforced as well. And this market is a little bit different than the stock market because it is a zero-sum game, as I explained. For every dollar made, there's a dollar lost. So if somebody on the floor is violating the rules, you know, trading after hours, for example, when the bell rings, then trading is to cease. If they're trading after hours, or they're shuffling their orders as they come in, they're supposed to take the orders according to the time they come in. If they're shuffling those, anything like that, the CFTC will really look to the Board of Governors to enforce, because it is a zero-sum game. Somebody on the floor is getting financially hurt if there's a violation of the rules. So for the most part, this institution is very adept at regulating itself, enforcing the rules, because members will complain if the rules aren't being followed. And as I mentioned, all the trades go through the clearinghouse at the end of every day. So the clearinghouse at the end of every day basically becomes the buyer's seller. So you have the buyers over here who initially go into the market and buy from another trader. The sellers initially go into the market and buy from another trader. But at the end of the day, the clearinghouse breaks apart the buyer and the seller. And if you bought today, as we go forward, for all intents and purposes, the clearinghouse is your seller. If you sold today, as we go forward, for all intents and purposes, the clearinghouse is your buyer. So you can rest assured that your contract will be honored, because as we go forward, you're not in a legal contract with that other trader in the pit. You don't even know who that is. You're in a legal contract with the clearinghouse. Any questions on the clearinghouse? And we'll get to the numerical example in a few minutes. Okay, the purpose of this slide is, again, just to try to, what I'm doing today is I'm trying to bring these pieces together. Okay, we've talked about bits and pieces on the market, and I'm simply trying to pull them together. So you know that there are hedgers and speculators, and for the most part, although this is not set in stone, but for the most part, hedgers tend to be sellers in the market. As I said, there are plenty of hedgers that are also buying, but hedgers on net, if we look at all the hedge positions in the major markets, for the most part, if we subtract the longs from the shorts, we'll find there are more short hedgers, which implies on the speculative side there are more long speculators. So that's just a fact of how the markets operate. So in this graph, we have long contracts, in other words, those that are buying, over on the right-hand side, the volume of long contracts. Over on the left-hand side, we have the volume of short contracts. And along the vertical axis, we have the price. That's the futures price. And that futures price ought to be related to some expected spot price, right? If we look at the price for March corn, March 04 corn, we can think of that price on the futures market today as a forecast of what the spot price for corn will be in the month of March at a specific location. And with corn, of course, it's Chicago. So you can think of that as a forecast of what the price is going to be when we look at the futures price. So the speculators use various techniques to forecast prices, and they come up with some belief of where the price might be in March, and that's shown here by point E. It's right here. That's where the speculators think the price will be in March. So if the futures price is below that, if we move to the right, the futures price is below that. Suppose that price is $3. They expect the spot price is going to be $3 in March. So if we move down to point C, let's suppose that price is $2.90. So at $2.90, the speculators are willing to buy because the price is less than what they think March corn will be. And the volume that they're willing to buy is given by this distance. So at price C, you can think of this as the demand curve for long positions. Of course, if the price goes above $3, $3 our expected price in March. If the price is above $3 and someone's trying to sell it for $3.10, speculators aren't interested. In fact, at that price, they want to sell. So a rational speculator would only buy if the price was less than point E. On the other hand, you have these hedgers who are not really forecasting the price, but they're trying to minimize their exposure to price risk. And so they want to sell futures on net. And it turns out that the higher the price, the more they want to sell. So if you were a corn farmer and the price was $5 a bushel, well, you haven't seen that price in 20 years. So yes, you want to sell your entire crop forward. If the price is $1, well, price is in the basement. There'd be little enthusiasm for selling at that price. So the higher the price, the greater the demand for short positions. So we have this line, WX, that shows the willingness of hedgers to sell as the price rises. And as the price rises, let's say from B to E, then the number of short positions desired will increase. So we have the hedgers and we have the speculators. You know that the two must balance. For every buyer, there's a seller. So as a result, the futures price might settle somewhere like point B. At point B, the speculators are willing to buy a volume equal to BC, and the hedgers are willing to sell a volume equal to AB. So that's where the two meet. So hopefully that helps you understand a little bit about how these participants come into the market. And this is basically a conceptual explanation of how these prices are formed. In a rational market, you would think that the futures price is slightly below the expected spot price. However, if it's a very competitive market, there's a lot of speculators, they will push this price B up towards E. In an actual fact, the way the markets work, there's not a huge gap between B and E. In fact, I mentioned to you the other day that on net, the hedgers are able to purchase insurance for a very small fee. So it's not as though the speculators are extracting very high premiums from the hedgers. Yes?
For speculators, if the demand above E is 0, why does that line keep on going to the left?
If above E, actually their demand becomes negative, and at that point they want to sell. Okay? Because if, let's say the price, let's say E is $3, and if somebody walked onto the trading floor and said, I want to sell at $3.10, the speculator would say, no, I want to sell at $3.10 too. So the speculator goes away and has coffee, comes back, and that hedger that wanted to sell at a high price will have to lower their offering price. And so maybe after the speculator walks back into the trading pit, they say, I want to sell at $2.90, and the speculator says, fine, I'll buy. Does that help? Yeah. So if the price gets too high, everybody wants to sell. And there's no trading. Some days the trading is light if the market moves rapidly in one direction. In fact, there are some contracts where the CFTC establishes position limits, which is the amount that the price could move in one single day. And so it's possible the market can be up or down the limit and there's no trading. That happens periodically as well. Okay? Whoops. Now I'm going to come back to this example. I just skipped through an example on buying the euro because I really want to talk about the clearinghouse, and if we have time, I'll come back to that example, okay? So I'm hoping that this example that we're about to discuss really solidifies in your mind how these markets work. So you know there's a clearinghouse, and you know the clearinghouse balances the books. And you know there are buyers and sellers. And you know there are margin calls. But how does this all work, right? That's the question. So here we have a given day, and I'll call that time period 1. We have a buyer. I'll call that person A. And we have a seller. I will call person B. What we're trading is one gold contract on the COMEX, 100 ounces of gold. And the contract size times the price will obviously give us our total value. So if the price is $360 an ounce, then the value is at $36,000. So on day 1, trader A places an order to buy one December gold contract at $360, which means they're willing to take delivery of 100 ounces of gold in the month of December and they will pay $360 an ounce. And you know, to enter into that trade, they only have to deposit $2,000 or $3,000, which is the initial margin. So they put down their initial margin, they put in an order to buy 1 gold contract. At the same time, on another part of the globe, there's an individual we'll call B. B also deposits margin money, also puts in an order, but it's the opposite order. B wants to sell gold at $360. So these could be 2 speculators, they could be 2 hedgers, or one could be a hedger and one a speculator. It doesn't really matter. B is entering into the opposite commitment. They want to sell gold. They agree to deliver it in December, and upon delivery, they agree to accept $360 an ounce. So those 2 trades meet on the floor of the exchange, and we have an open position. So what does the clearinghouse do? Here's the clearinghouse position, column 4. Well, the clearinghouse steps between these 2 traders at the end of the day. It steps between the 2 traders. A was buying, B was selling. So the clearinghouse says, from now on, person A, I'm your seller. As far as you're concerned, you sold it, you bought it from me. Okay, I'm your seller. Clearinghouse says the opposite to trader B. It says, from now on, trader B, I'm your buyer. You sold it in the trading pit to an unnamed trader, but I'm breaking you 2 apart, and from now on, I'm your buyer. So trader A now has an open position with the clearinghouse. Trader B now has an open position with the clearinghouse, and the 2 balance one another. The clearinghouse is not at any financial risk because they have agreed to buy gold at $360 and they've agreed to sell gold at $360. So the clearinghouse is not financially exposed. And at the end of the day, we have 1 open long and 1 open short. Okay? So the volume is 1, the open interest is 1 at the end of the day. Now let's go to day 2. So on day 2, let's suppose the market's up. It's up to $370 an ounce. So the market's up strong. B bought at $360, but you know that legally B has just agreed to buy in December. So now it's the second day of trading. B sees that the price has risen $10, so they decide to sell. They're going to take their profit. They're going to get out. So they put in an order. Did I say B? I meant to say A. I'm sorry. So A bought at $360. Now they're going to turn around and sell the next day at $370 because they've made a nice profit of $1,000. So the second day, A puts in an order to sell. Calls a broker, puts in an order to sell at $370. Yes? No, this is correct up here. I just misspoke. Okay? I'll just go back and clarify it. On day 1, A is a buyer, okay? And B is a seller. On day 2, A decides to reverse his or her position or to liquidate, okay? So on day 2, A is going to liquidate. So they put in an order to sell. Now, of course, for that order to be filled, somebody has to be willing to buy at $370. So there's another trader somewhere in another part of the globe that decides that they're going to buy at $370. Again, they could be hedger, speculator, it doesn't really matter. They send in an order to buy at $370. A's order is sitting there to sell at $370. So again, there's a transaction where C buys from A. The price is $370. The clearinghouse now says to A, for all intents and purposes, I'm your buyer. It says to C, for all intents and purposes, I'm your seller. So when the clearinghouse now evaluates, runs the computer at the end of the day, they see that on a previous day, the clearinghouse was A's seller, and now the clearinghouse is A's buyer. In other words, they have two commitments to A, but they're offsetting. So as far as the clearinghouse is concerned, A is out of the market. Right? The clearinghouse agreed to sell to A at 360, agreed to buy from A at 370. So at the end of day 2, the clearinghouse will pay individual A $1,000, and they're out of the market. Now, where does the $1,000 come from? Well, that's where margin calls play a role. Individual B sold at 360, I'm sorry, on day 1, 360. The price has risen to 370. So if you sell low and the price rises, then you're losing money on paper. So they agreed to sell at 360. It's now 370. So if they reversed their position, they would lose money. So what the clearinghouse does is it calls trader B. And it says, well, you've sold at 360. Now the price is at 370. Please send $1,000 a margin call, wired immediately before the close of business. So B wires the $1,000 in. The clearinghouse pays A. A is out of the market. At the end of the day, volume, again, is 1. There was one trade that particular day. We have an open long and we have an open short. So the open interest is still 1 because C essentially replaced A in the market. Now let's go to day 3. Let's suppose on day 3 that the price falls back somewhat. It falls back to $365 an ounce. So the price has fallen back. B sold at 360, experienced a margin call. Now the price has fallen back a little bit. So B decides, well, I'm going to cut my losses and get out. So B had sold on day 1. To reverse that position, they must buy. Right? If you sold initially, then you must buy to reverse it. So B puts in an order down here in the last row to buy gold at 365. C on day 2 had bought one contract. Individual C had bought one contract at 370. On day 3, for whatever reason, they decide to get out of the market. The price is 365. They agreed to buy at 370. Now it's at 365. So they've lost some money. But it's possible that going into the trade, C said, well, I think the price is going to rise, but if it falls tomorrow, I'm going to get out of the market and cut my losses. So C also liquidates by putting in an order to sell. The clearinghouse breaks that transaction apart, and the clearinghouse says, well, person B, I'm now your seller. Person C, I'm now your buyer. And so it matches up the positions with B. It matches up the positions with C. And as far as the clearinghouse is concerned, both B and C are now out of the market because the clearinghouse has equal but opposite commitments with both traders. So they're both out of the market. Now what about the $1,000? Where does that come from? Remember, A walked away with the $1,000. So how does the clearinghouse settle its books at the end of day 3? Where does the $1,000 come from? Pardon? B and C. So B had put up 1,000 additional margin money, right? And then the price fell. So at the end of day 3, you're right, they would get $500 back. So they're out $500. C agreed to buy at 370. It's now at 365. And C liquidates. So if you buy high and sell low, you're going to lose money. So C loses $500 and must pay that to the clearinghouse at the end of day 3. So at the end of day 3, The open interest is 0. The volume was 1 that day. Open interest has gone back to 0. And our 3 traders are out of the market. A walked away with $1,000, B lost 500, and C lost 500. Okay, does this help at all? Must have some questions on this. Did you follow me when I'm calculating the open interest and how that differs from the volume? Yes? Okay, I hope this did the job because there's really a lot captured in this example here. We see how the clearinghouse manages to break even. We see how the financial integrity of the contracts is maintained because these traders don't have to worry about whether they're trading with B or C. All they have to worry about is that the clearinghouse is financially secure, which it is. And if one of these traders decided to skip town, you know, if they rang up trader B at the end of day 1 and couldn't get a hold of that individual, well, the broker who handled that trade would be responsible for the position. And then ultimately, when a trade is made on the floor, if it's made by a brokerage firm that's not a member of the clearinghouse, at the end of the day, that trade must be, quotes, cleared through a member of the clearinghouse. So as I said, the clearinghouse might have a membership of 250 out of a total of 500 at the exchange. If I'm on the floor, but I can't afford to be a member of the clearinghouse, I have to find a member that will clear my trades for me. So at the end of the day, that clearing member clears the trades, and it's actually that clearing member who's ultimately financially responsible. If my client skips town, I skip town, it's the clearing member who's responsible. And that's why there's never been a default on trading, because these clearing members are financially secure, they're well bonded, and there's a lot of security behind each and every trade. Okay? I can do this example just in a couple of minutes because I know some of you are anxious to get trading on StockTrack. So I've been discussing the euro at length. You've been reading about it in the Wall Street Journal. I'd like you to keep track of what's going on in that market. And here's an example to get you going on StockTrack, and it's very simple. If today you decide to go long in a euro contract, let's say it's March, and the price is 93 cents per euro, then that's the price that you initiate your trade. And then in December, as we wind down the quarter, you have to liquidate that position. And let's suppose that the dollar does become weaker. Everyone's predicting the dollar is going to get weaker. If the dollar is weaker, then the price of the euro quoted in dollars will be a larger number. So this is very important for you to understand, because once in a while on the quiz or the midterm, I might give you a price quote the way you see it in most newspapers. A lot of newspapers will write euros per dollar or yen per dollar. It's easier with the yen because there are 120 yen per dollar, and it's much easier to write that than have a bunch of decimal points. But the futures market prices are always quoted in dollars per foreign currency. So if you see on an example where I gave you the price foreign currency per dollar, you must take the inverse of that. It's always dollars per foreign currency. So it rises from 93 cents per euro to 99. In other words, the dollar weakens. To calculate your profit or loss, you simply take the price change, which is 6 cents, 6 cents times the contract size, which is 125,000 euros, right? So this is this 6 is dollars per euro, right? Times 125,000 euros. So the euros will cancel here, and we're left with our outcome, a profit of $7,500. You bought at 93, you sold at 99, the price went up, so you made a profit. If we do the same trade, exact same trade, you bought at 93, and let's say the dollar strengthened instead, and you turn around and you sell at 85. So whenever you're selling below the price you bought, you're going to lose money. That's pretty basic, but some students get confused, I know, when it comes exam time. So if the dollar strengthened instead and went the other direction, then you would lose money. We take the price change, 8 cents, contract size. That gives you your size of your loss. Okay, I'll see you on Friday.